Well, Tanvir, I wanted to bring Daniel Gerard into the conversation now. He is Senior Multi-Asset Strategist at State Street Global Markets, joining us on the line from Singapore. And Daniel, before we get into the conversation about what's happening across Asia equity markets today, I wanted to get your take on a debate that we were having earlier on in the show. Over in the United States, we've seen the Dow having its best run-up last week since 1938. But it seems like these markets are defying the data to come. What's going on in the United States? Is this a dead cat bounce, a head fake rally, or the buying opportunity of a lifetime?
No, that's a great question. I was going to ask you if you had the answers to that. But I think that, the way we need to think about this is information is going to come in stages. And there's been almost a sort of a narrative in the U.S. that for this crisis that the Fed and that fiscal policy from the government were there to actually boost markets. And I actually don't think that's the case. This is a crisis unlike we've seen before, and societies are really slow to adjust risk models. People and individuals and corporations can adjust risk models without experience. Societies don't really do that well. So I think what this means is they needed the experience to react to a health crisis. What they had the experience for was a financial crisis. And they were very, very quick to react to prevent illiquidity turning into catastrophe, turning into insolvency, et cetera, so far. And it's probably saved the market. But what the idea there is to put a floor under it so that market participants can figure out what companies and securities are worth. And I think we're starting to see that. We're starting to see the fear taken away of the governments don't know what they're doing in terms of the financial crisis, and allowing that market participants to step back in. That doesn't mean we're going to see a straight line recovery up again. I don't have much faith that that's going to be what we're going to see from here. I think that no one has real insight yet into the impact into earnings, the fundamental drivers of markets here, and that's the next stage that's going to come.
Yeah,
we're going to start to see what happens in the earnings space and how long or how short that's going to be.
You're exactly right. It seems like governments and central banks have been trying to financially engineer us out of a global health emergency. Asset markets have reacted in their own way, but when you look at the fundamentals today in the United States at least, do you think this has set the stage for an economic and perhaps even market rebound in the second half of the year? We've got massive QE infinity, rates on the floor. It seems like things do have the potential to come back to normal depending on how the virus plays out.
Yes, I think that this is what we have to remember. It's a supply and a demand destruction at the same time, which again, it doesn't allow price to be the element that brings us out of either supply or demand issues, because they're both happening at the same time. So the recovery from those two issues, supply and demand destruction, is going to be asymmetric, and that's why, again, I think we're going to see a bit of a choppy recovery in the back half. And I know we'll get to Asia in a second, but it's going to be part of the supply chain, which is, can companies find a customer to get their product out as the production comes online again or improves again into the back half of the year. So I do think that we're set up for a back half recovery. Again, the other part of this is, are we willing to take the pain in the near term? And taking the pain means really taking the pain and closing off to flatten the curve as much as possible. I know this is getting to be a bit cliche, but it's still a big debate. And if you cannot overwhelm your healthcare system, and if you can, slow the pace of infection by just taking near-term pain, we saw that in China on March 15th, or I think it was the last time I was on. So we saw some of the worst China data that we've seen in modern history, and it wasn't even the top story of the day, because investors saw that more as a one-time charge to corporate earnings that they'll look through. If we turn this into repeating impairment to earnings in a society economic sense, then it's going to be really painful down the road.